Hey everyone, it's Gloria here with Remax Little Oak, and today I'm here with my good friend Mike Morisset, and Mike is a local mortgage broker in the Fraser Valley area. Hey Mike, thanks for joining me today.
Thank you very much for having me.
Good. So today we're going to be talking about mortgages, but first I'm going to start off with Mike, and I'd like to hear a little bit about your company and yourself.
Well, I'm a local mortgage broker, work mostly out of the Langley area and the surrounding communities. Been in the business for almost 10 years now and gone through the sort of slow times of 2008, 2009 to the craziness of last year's market to sort of a more common market now.
Yeah.
But one of the unique things about how I work is I have two other mortgage brokers that work for me.
Okay.
So I have a lot of support to help us educate and make sure the clients are making the right decision through the whole process. So we do a lot of work up front to help make sure people like yourself are making good financial decisions, and we're looking far enough ahead so that we can sort of be a devil's advocate for you too at the same point.
Great. Well, Mike and I have known each other for 10 plus years, and we've done a lot of business together.
Yes.
And a lot of fun. So today I've got a bunch of questions for you, so
Yes.
hopefully you're going to be excited about this. So what does a mortgage broker do, and why do some people work with one and some work with a bank?
Most times what the perception is the mortgage broker is somebody that charges a fee to the client and that we're out there. So what it is we are paid fees, but the vast majority of the mortgages that we do, we actually get paid a fee by the lender. So that what we do as a mortgage broker is we take your application in, we review the documentation, we review your sort of story behind your application, and then we can identify the, say, 5 lenders that work really well for your application. And then out of that, we take into consideration the terms you're looking for, prepayment privileges, credit score, all that, and we say, okay, this is the best lender for you with the best available rate. So we have access to, they say 40 lenders, but we really work with about 10 really core lenders, and we can identify which ones work best for the client and hopefully get the best available rate, but also the best fit for the client too.
Okay, sounds good. Hey Mike, so the next question I want to talk about is the stress test. How does it work, and how did it affect us as buyers and you being a mortgage broker?
Yes, well, it has had a big impact on our business. So one thing to make sure everybody understands, there's always been some form of a stress test in place, but it's gotten tighter and tighter and tighter. So a long time ago, there was a stress test for a variable rate mortgage that was a little bit higher than the actual rate. But over time, when the Canadian market really started picking up and prices kept on increasing, they kept on tightening the rules. So in the last, say, year and so, we've been dealing with a market that for any kind of insured mortgage, so less than 20% down, anything that is a variable rate with more than 20% down, we all have to stress test at the Bank of Canada rate, which right now in today's market is 5.34.
Okay.
So that's sort of the low end mark. If you go with, say, a 5-year fixed term, you have to do the 5-year fixed term plus 2%.
That's 2%.
So your actual rate will be the contract rate, which is, say, 3.89 for a 5-year fixed, or say 2.6 for a variable, but you have to qualify at a much higher benchmark, which is really limiting for the market.
Right.
And makes it so it's very difficult, especially for single people, one income source. It's very difficult to really get, even if you make $100,000 a year now, you have to really set things up properly to be able to qualify under the stress test.
Okay.
So it's really made it more difficult for people to buy, but not impossible, just a lot more planning required.
Okay, so and two, it means your buying power that you can't really afford to buy as much as you used to when they brought this in as well. So
yeah, in some ways too, it's an equalizer too. So if you are somebody with 5% down and you have to qualify under the stress test, everybody's sort of treated the same way.
Okay.
So that you don't have to. It does make it so that everybody's sort of impacted the same way when it comes to their purchasing power. So it sort of did cool the market that way. In some ways, it's really good. Some ways it's really a challenge, right? It's been difficult for certain people, but we all evolve with the market, and just because the stress test is this high now doesn't mean that they won't ratchet it down and make it more affordable for people, or easier for people to qualify in the future when they feel the market is sort of cooled off a bit.
Okay, great. Thanks for answering that. All right, my next question. What are the required documents needed when you are applying for a mortgage?
That's a loaded question because there's more and more documentation required today. One of the things that the government has really pushed us to do is make sure that we know our clients so that we understand sort of all aspects of the risk of the file. So documentation, the first thing we get up front is an mortgage application, which sort of includes your SIN number, birthday, your legal name, and gives us sort of a background of where you've lived for the last few years, where you've worked for the last few years, and along with your down payment, assets, liabilities, all that information. And then basically after that, what we need to do is go through the process of verifying that your application is accurate and that we can use the income that you have. So we do stuff like letters of employment, pay stubs, T4s, notice of assessments. That's the document you get back that has your RRSP limit room on it.
And you need to keep that. Never
Yes,
throw that
big
out
time,
because
yes.
it'll take you probably a good month before you can get that from CRA.
Actually, yes, that's a big thing. And one of the things you can do as CRA now too is get a password, so they can mail you a PIN number that you can set a password so that you can log in the future. So one thing we actually recommend a lot of our clients do is go through the process of getting that PIN mailed to them so that in the future, if they're missing a document, they can quickly log in, print off that statement, and send it to us in the future. So it makes it much more easy. So that's something that people should take into consideration. But we also need to go through the process of verifying all the down payment. We need to confirm all those details. And just because, say you have somebody that comes into us and says, okay, I made $100,000 this year. So they enter on the application, they made $100,000. But the vast majority of that year, say, was overtime. They worked a ton of overtime, and the year before they made $60,000. So you might have made 100, but I can only use 80 because they're gonna use a 2-year average there. So 60,000, 100,000, 2-year average, 80,000. So that's part of the thing is just we need, even though you're actually not lying to me, I have to verify and qualify you under the lender's guidelines, not what your T4 said this year.
So no matter what, you always go back 2 years.
Well, if you're a letter of employment, say if you're a full-time teacher or a salary employee where we have that consistency, every 2 weeks you get paid $3,000 or whatever that is, then we can use that. But if you're using a lot of overtime, or if you're in commission sales or there's fluctuation in your income, they're always gonna go to a 2-year average.
Okay, no, sounds good. All right, so next question. So how long does the approvals part take when you're wanting to get the mortgage?
Well, with proper preparation, which is my team, we're very heavy on getting documents up front. It's very important to us to make sure that we have a full understanding of what you qualify for, what your down payment will get you before they go with someone like yourself to write an offer, because we don't want to have people questioning, or like I said, we want to be, okay, the property's worth $350, the strata fees are this, and the taxes are this. Do we qualify? Yes, write the offer and don't worry about it. But so if we do all the proper documentation up front, most times you're looking at probably a 48-hour turnaround with approval. But there's comes back and we have the approval will come back with conditions. So sometimes it's just a simple condition of signing the documents, but sometimes there's other stuff that we need to do. We need to explain some sources of down payment. They need appraisals or title searches, different things that we need to do above it. But the core of the mortgage approval can be done with proper preparation up front within 48 hours, where we feel really confident in the file. And of course, people like yourself can move on to the inspection and due diligence on your end.
Exactly, and it's so important, me being a realtor, that you need to be pre-approved before you even start looking for a home, because why are you going to go through all that process and the work, and you're only going to be approved for 400,000, but you're thinking 500,000, and it's a huge impact when you're doing this. So it's really important, guys.
And especially in this market too, where it's just there's so many things that are taken into consideration that when I got in the market 10 years ago, we were doing 40-year amortizations. Now we're doing 30 to 20 or 25 to 30 years. There's so many things that have changed that have made it more difficult for people to qualify. But with proper planning, we can get around a lot of these things where we can, pay down loans or reposition loans, all these different things to qualify people better, but it comes down to preparation for sure.
Okay, well, thanks for answering that one. If you're new to Canada, what is required before you can apply for a mortgage?
Well, new to Canada is a bit of a different beast in general. It really depends on the source of down payment, how much down payment. So there's a wide variety of rules when it comes to qualifying. Most time what they're looking for is that you have employment, obviously, in today's market, but they also want to make sure that you have, obviously the source of down payment, they want to make sure that you're actually going to stay here. Right. They want to make, do you have landed status? Do you have permanent residency? Like, what's the story? And usually with new to Canada people, you sort of have a 5-year period to establish credit a bit. Okay. and, you know, get job going, you know, accumulate down payment, whether you're bringing it from your homeland or whatever that is,
Okay.
that's fine, but it comes down to, they just want to see the stability there. So they don't really discriminate against new to Canada, where they sort of have the programs to support that, but they want to make sure that it's not just a scheme to buy one house and then move back to China or to wherever you're coming from. They want to make sure that you're establishing yourself in the country.
Okay. Can that process usually take about a year, or can it be quicker than that?
It can be, but they definitely want to see that you're doing something to establish credit.
Okay.
Is the big thing. Like that's the biggest hurdle in most cases with people, is that like, you're coming to this country, you might have a down payment, you might even have $50,000, but then you have to get a credit card, and you have to sort of establish it, and you can get around those programs, and you can get around it, but it's really important that the more credit you establish today up front has a big impact in what lenders are going to do for you, because it just definitely sort of reevaluates what the actual risk is going to be with that client.
Okay, no, that's great. Thanks for answering that. And so, you know, the appraisal part, when you're getting to the final part of the mortgage and you're pulling everything together, and I know that we always have to get an appraisal, how does that impact the mortgage? Why do we always have to have an appraisal?
Well, it's the factor is it depends on the kind of mortgage you're getting. So if you're getting less, if you have a mortgage with less than 20% down and you're paying an insurance premium up front, most times the government or the insurance backer, if the appraisal is required, they will pay for it.
Okay.
But most times they have enough transactions in the community that they know what the value of that property is approximately, and they don't really require an appraisal up front, unless there's something really in the system that triggers something. Might be that they've overpaid or underpaid. Any of that will trigger an appraisal, but most times we can get through with less than 20% down without an appraisal. In this market, basically anything over 20%, I plan on having an appraisal done. It's just part of the process, but there are two different versions of an appraisal that can happen. One can be an electronic one, so they enter the information into the system and it comes back with thumbs up, the value's there. If that doesn't happen, which is sort of a 50-50 shot, then they order the appraisal that comes through, and the appraisal will come actually to the property and just literally look around, count the rooms, look at the aesthetics of the property. Is it good condition, poor condition, and then they'll look at recent sales, and they'll sort of come up with a comparable number, and that number comes back, and it comes back with the appraised value. So say if you buy a property for $300,000, but the appraised value comes back at say $290,000, the lender is going to come back and they're going to say, okay, we will lend on the appraised value.
Okay.
But if the appraised value comes back at say $310,000, they're going to do it on the purchase contract.
Right.
So they're just making the appraisals there to basically protect the lender and make sure that they're not lending on a property that is in poor condition, or they tell me they just doesn't fit their portfolio of business they want to be involved in. But it's just basically to make sure that the value's there, that they're making a wise investment on their end, basically.
So how long can that appraisal process take before you get the final answer?
In our market right now, we're looking at about probably a 48-hour turnaround for business days.
Okay.
So if we get ordered up on a Friday, we probably get it back Tuesday at the end of the day. So 1 day for order, and then 2 days to actually get it done and report back to us. But it can happen faster. But in very busy markets, if we're sitting in a spring market or a hot market, it can take up to a week to get done.
Oh wow, that's a long time. So
Yes.
we really have to be, us as realtors, making sure that our subject removal time, base it on 10 days, not that 7 days, unless you've talked to your mortgage broker and you know that you can do that time frame.
Well, I think the biggest thing today is more important than ever before is the partnerships you have. So that the ability for the realtor to call the lender or the mortgage broker and say, hey, this is what we need to do. Can we coordinate this properly?
Right.
And make sure that everything's sort of coming together. In previous markets, it was sort of just helter-skelter, just get the deal done. In this market, we need to be much more coordinated, and you need to have the mortgage lender or broker, the realtor, inspector, lawyer, sort of everybody on the same page to support each other, because it is much more challenging in this market to get things done.
And you're right about that too, and especially when I deal with buyers and then they're dealing with their own bank and I don't have that relationship with their mortgage broker, it's really hard to get information. So when something goes wrong, at least I know with you, we can talk to each other. I know how to handle the situation, because you're right, it's like
it's not a 9-to-5 industry anymore, right?
Everything falls as a domino effect, right, for everybody. So it's really important that you do work closely and you share all that information.
Absolutely, and it's just something that as a buyer or a seller on your end, just putting some time and energy into that up front
Yeah.
just makes everybody's life a little easier, and making sure, even if it's not, say, hey, you could be with TD or RBC and say, hey, I don't want to work with a mortgage broker, I want to work with that person, but at least introduce and coordinate properly with your realtor and make sure that everybody's doing things in a proper order, because it doesn't work if you're not working in sync and as a team.
Right, no, it's a good point. All right, one of the big ones, CMHC. What is it and who does it apply to?
Okay, so CMHC is Canadian Housing Mortgage Corporation, and what they're there for is to basically insure mortgages for less than 20% down, or under specific programs that might be business for self. They also have insured programs there, but we won't get into that right now. But what they do is basically they take, if you're putting down less than 20%, they'll insure the mortgage. So they basically say, hey, buyer wants to buy house A, we will secure the mortgage, and we'll say, okay, we'll insure the mortgage, so if the client does default, that the lender is protected and they will get all their money back with return. Okay. So the insurance premium is for the lender's benefit. Okay. But when people say, well, that's not fair or whatever it is, but from a lender's perspective, if you're buying a house for $500,000 and you're putting down $25,000, it's a very high risk for that lender in the sense of getting their money back. So having the insurer in place allows people to come up with 5, 10, 15% and get in the market and get a high quality rate at the same time. So it does sort of allow the market to exist, but it's something that people do need to take into consideration. Okay. So when you do get CMHC insurance, the maximum amortization is 25 years.
Oh, okay.
And you have to qualify at the stress test. So at 5.34 in today's market at the Bank of Canada rate. So it's a bit of a higher standard. The credit scores have to be higher, all those things. So a little bit of preparation has to happen there. Okay. But it's definitely for anything less than 20% down, CMHC insurance is required, or what they call CMHC insurance.
So the more of a down payment you put, the better position you are with
the less of a premium you pay. And when you get to 20%, then you can choose to do 25-year, and you can also choose to do 30 years. So it expands your purchasing power to a point. And obviously, with a larger down payment, there's less risk for the lender because of the fluctuation in property values.
Yeah, and that's when, like you're saying, that's when an appraisal would come into play, because you're doing 20%, because the lender does.
Right, then they want to make sure that is it actually 20% at that time?
Right.
Is there, that's what they're trying to make sure on their end, is making sure there's enough equity in the property to take care of that risk.
Okay, good. All right, your credit score, we kind of touched a little bit about it. Now the credit score plays a big factor in getting a mortgage, like you're saying, the higher
bigger
the
than
credit.
ever, yes.
So tell me a little bit about it, and how can we improve our credit score when we're trying to apply for a mortgage and it's a little iffy?
Well, it's way more important than ever before. And in both the last 18 months, the government the credit reporting agencies have improved their systems. So they've upgraded, so it's very sensitive to things like missed payments. And people are like, okay, well, I have a $5,000 credit card and I only had $50 on it and I missed a payment. Doesn't matter, you missed a payment. So you need to be really diligent with your credit. Collections, we have people with cell phone bills and they just don't treat it like it's really a serious bill. They're like, oh, I didn't have the money this month. So they report that, and it really impacts your credit. So we're finding that, like, say 2 years ago, you could have a 600 credit score, which is not a great credit score. I would classify it as a weak score, and you could probably still qualify for a mortgage. In today's market, they're looking for minimum like 650, so a big jump up, and they're looking for clean credit. So even if you have like a 700 credit score, if you have late payments on it, that you have collections on it, they want explanations and good explanations for why your credit score has been impacted or why this has been reported. So it's really important for people to take care of that. And that's one of the things we do up front, is we do pull credit up front. And we do make sure that if we see anything there, that we're taking the steps to fix it. So it could be collections, it could be a couple late payments on a credit card, it could be you're a couple dollars overdrafted. Any of those things that we can do to improve that will improve credit score.
So we can do that quickly though, like we don't have, like that time frame, it's not going to take a couple of months, it could
Everything's a bit different. So you could be, if you're sitting in a situation where, hey, if you've missed a couple credit card payments, they need to see a longer history of improvement and showing that, hey, I'm back on track and I'm managing my debt well.
Okay.
There's also the point that they're also going to sit there and see, like for example, if you have a $5,000 credit card with 5,500 on it, you can, that's not going to report as being late, but it'll report as being overdrafted, and that will lower your score.
Okay.
So if you pay that down and get under the $500,000 marker and get it back within the limits, that can increase your score quite quickly.
Okay.
Other things like late payments, collections, the more severe the action, the more the severe the result, right? So it comes down to, so if you let a credit card go for 5 months, that's a big, longer time to improve it for sure.
Oh, wow.
Over time. And there's things that you can do too to improve credit, like obviously paying things on time, making sure you're paying off your collections if you have anything, like parking tickets, all those little bits and pieces, but also making sure that you're managing your credit properly too. So if you have a $10,000 credit card, having it maxed out at like basically $10,000 every month, and that shows that you're not managing credit properly.
Right.
So they're saying, okay, the credit card shouldn't be there for your lifestyle. It should be there sort of for emergency funds, for overflow, and that you should be, if you have say a $10,000 credit card, if you carry a balance of $2,000 to $3,000, $4,000, $5,000, that's fine. But when it's maxed out all the time, that drives your score down because it says that you're not managing it properly.
Right.
And they're looking for how you're managing debt.
Yeah.
And from a lender's perspective, if they're giving you a $500,000 mortgage,
Yeah.
and you can't manage a $5,000 credit card, you can see where it comes into play, right? And I do appreciate perspective of a client saying, hey, I just made a mistake, but
Yeah.
you made a mistake on a $5,000 credit card. What are you going to do with a $500,000 mortgage? And it is something to take into consideration. People do get upset with all the questions sometimes, and I'm like, I understand, but you're asking for a lot.
Well, it's a
of money
personal
too.
thing, so you're just trying to make sure they can get the mortgage, and as much as, as being the person who has a bad credit rating, you feel horrible about it.
Yeah.
It's really important because it's just little things that can hurt you so much with it.
Yeah, that's an interesting point too. I think a lot of people too get really emotionally attached to their personal finances. I do too. Like, it's not something I want to open up my books and show people. But you have to realize from our perspective, we don't really look at it like, oh God, Susie has a really bad credit score, or like laugh or whatever it is. It's like, okay, here's the problem in front of us.
Yeah.
How do we fix it? Is it manageable? Can we help them along?
Yeah.
And then, so it's like, everybody makes mistakes. I've made mistakes that I don't want to share and broadcast. We all have done it. So just understand that we've all been there. We've all done it. That's part of life.
Yeah.
But it's just a matter of how you make the mistake and then how you recover from that.
Right.
So
Yeah, and by not getting everything together and organized like how you should, the process is going to take so much longer when you
Yeah.
need to get that mortgage when it really counts, right?
Yeah.
So, and that's stressful because it doesn't mean that, oh, I'm going to just stop doing what I got to do. It's going to take a process. Just keep going and going. The end result is to get you a great home and to find something that you love and that
Yeah.
you're happy and that you can manage.
yeah,
with it.
it's pretty. Like a lot of the whole process of getting to the point where you go from being a situation where you need to improve with. The biggest challenge with this is it's very boring. Like, you can't really do a big, impactful movement at a time. Like, it takes time to get, save the down payment. It takes time to improve your credit. It takes time to get the better job. That's the biggest challenge that people have with it. There's no instant gratification to it. So you just have to know, hey, dedicate the time to get it done, and then the reward will be there. And then over time, as you've known and I've known, owning real estate and the impact over, at my age, probably having a home for 15 years, it's had a huge impact on my financial future, right? So it does take time to get into the game, but once you're in the game, it can be very impactful for you.
So don't look at it as a negative, it's a positive, and just keep going with it.
It's just
and it'll all
obstacles,
work
yeah,
out.
exactly, just obstacles, right? We all have them.
Exactly. All right, good one. All right, so the different types of mortgages, we have a fixed rate, we have a variable, and open mortgages. So a little bit of input on each one of those.
Okay, so a fixed rate is something that you can do from basically a 1-year term to a 10-year term. Every lender sort of has different products they offer.
Okay.
But with a fixed rate mortgage, it's more based, it's locked in. So you're saying, okay, I want a 5-year fixed term. I want my rate to be just for a quote 4%, and you are going to be locked in for 5 years, 4%. Your payment every month is going to be the same payment. Doesn't matter what's happening in the world, locked in. But for that, you're also locking in, so if rates go down lower, you have to pay a higher penalty to get out of that mortgage to get the lower rate. So there is, people find that a fixed rate mortgage is less risky, and it is to a certain point, but there is also the downfall of being locked into something. If something changes in your life, which as we know, every 5 years there's always twists and turns, so you sort of have to plan for that. So if you're a really conservative person and you just don't want to, you just want to have something steady Eddie all the time, I understand that, and that's what a fixed rate will give you. It just locks everything in. You know, you don't have to think about what your payment's going to be every month.
Right.
When you go over to a variable rate mortgage, it's based on a rate is basically it's a prime. So the prime rate is set by the Bank of Canada, and that changes, which is recently it's been going up pretty steady for, you know, every couple months. They seem to be hiking it by about 0.25%. When you do that, your rate will fluctuate, your payment will fluctuate, but the interest you pay will be based on that prime. So whether you have a discount or a premium charge to prime, so right now prime is 3.95. If you were doing prime minus 0.25%, your rate would be 3.7. But as the prime rate increases by 0.25%, so does the interest you pay on your mortgage.
Okay.
So it has that fluctuation. I've been doing a variable rate mortgage forever. I've never done a fixed rate mortgage. And it's in turn saved me thousands upon thousands of dollars because the discount is lower. And in the market that we were in, it sort of set it up that way. But over the last couple of years, it hasn't been so good for me on my end. But it is the sort of the market of it. It does fluctuate. The benefit of that is it gives you a lot more flexibility. It also gives you the ability, simple math. So if you want to break a variable rate mortgage, it's a 3-month interest penalty, and it's really allows you to have maximum flexibility.
Right.
And then when it comes to an open term versus a closed term mortgage, that's based on basically penalties. So if you have an open term mortgage, you pay it off at any time, no penalty, you just pay it off and close down the account. The downfall of it is it's a much higher rate, because if you're going to be a lender, I need $500,000, I want an open term mortgage, you can pay it off at any time.
Right.
So it's not a very profitable mortgage. So they raise the rates to make it more attractive for the bank. Special enough. So closed rate mortgages, it's locked in. So your 5-year fixed term, closed, locked in, 5-year variable term, closed, locked in. It's just a matter of different penalty structures with those different products.
Right. Okay, so what about porting over a mortgage? Like for me, because I really deal with a lot of seniors in the 55 plus, and you know they're established. They've owned 2 homes, 3 homes, and now maybe they want to downsize, or or maybe they're helping kids out or something, and they're porting their mortgage over. Can you explain a little bit about that?
Yes, most mortgages are portable to a certain point. There's always circumstances. If you're changing from, say, a single family home to a townhouse, some lenders don't like that. They don't want, this won't work with that, so they won't lend on it. Or if you're going from, say, we have a lot of people in the local area going from, say, single family to a townhouse on First Nations land on a 99-year lease.
Oh, yes.
So things like that, if you're changing the structure of it, then the lender could have a problem with the property, and they just don't want to do that. On the other end of it, when it comes to income, so say you were a teacher, you're making $80,000 a year, you retire, you have a $400,000 mortgage, and then all of a sudden you go from that to having a, say, $40,000 a year, pension.
Right.
You have to re-qualify for that mortgage. So they're just not going to let you take it from property A to property B. At that point, you do need to re-qualify, and the reason why is they want to make sure they're reassessing their risk at that time. So there's reasons why people sell their homes and move. Well, some of it's to upgrade, downsize, all these positive things, but there's also negative things: divorce, death in the family, loss of job. They want to make sure that they can re-evaluate the risk. So basically, you're basically reapplying for the mortgage or reapplying for the privilege to port it.
Okay, no, good answer. So tips on paying off your mortgage sooner. That's a big one for everybody. We all want to do that.
It's a really, and it's funny, again, I said earlier about the delayed gratification. It is the most boring thing ever, but just putting an extra $50 on every month, every payment makes a big difference. So you have the ability with your mortgage, you're going to have a couple different options. You're going to have, depending on the lender, everybody's a bit different, but you have certain privileges. So you can have, with certain lenders, you have privileges of prepaying your mortgage on the original mortgage balance. of up to say 10 to 15 to 20%
Right.
that you can prepay every year
Okay.
within the calendar year without a penalty. So if you have a $500,000 mortgage, you could pay down $100,000 a year without
Wow.
penalty at all.
Oh,
So like
that's great.
huge impact if you have that privilege.
Yeah.
You also have the ability to increase your payment per year by up to 10, 15, 20%. So if you have a $100,000 mortgage and you have a 20% prepayment privilege on your monthly payment, you can increase your payment to $1,200. So very impactful, and it can, over time, that has a huge impact on how much interest you're paying
Yeah.
over your mortgage. You can knock off, like if you do a 20% increase, you can probably knock off 5 years in your amortization.
Wow.
Over the course of time, it does have a huge impact and saves you tens of thousands of dollars, but it just is a very slow process, and it's not very fun or sexy or whatever you want to say. It's like pretty boring, right? It's pretty mellow, but that's sort of the story of life when it comes to real estate and investing. Like we've gone through a really hot market
Yes. we
where
did.
prices were increasing, but even in the old market where you were just doing standard real estate inflation over history, over time it's a great investment, but you need time. And we've been really blessed in this market. You can see our prices increase really fast,
Yes.
but this is the slow process. And you see these people like who are living in Vancouver now, old 80-year-old couples that are sitting on properties that are worth $5 million, and they bought it for $25,000 50 years ago, and they just paid it down,
Yeah.
steady Eddie,
Yeah.
simple life, and they've created this great sense of wealth just by doing the simple, slow, boring thing.
Yeah, exactly. Well, there's so much information, and I really do appreciate you coming out here. I know we could talk about mortgages, but Mike, I thank you again for coming
Awesome.
out, and it's been a lot of fun. And you know what? I will have Mike's contact information for you guys if anybody wants to reach out to him. And like I said, he's awesome. He'll answer anything that you guys need and sit down and go over whatever your needs are when you're wanting to apply for that mortgage.
Absolutely, we love doing it.
Okay, thanks everyone.
Thanks a lot.